Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyadjian. We'll kick off the week by talking about the UK political uncertainty. We've seen the sterling pound fall by around 2.5% following the UK election result, where Prime Minister Theresa May's Conservative Party lost its majority in Parliament. Now, the Prime Minister is trying to lead a Conservative and Unionist Party coalition, but we expect further risk of political upheaval, especially if Prime Minister May is forced to resign. So watch this space this week. We expect the sterling pound to find near-term support around its 200-day moving average of about 1.257 as Brexit delays loom. Now, we've seen the sterling pound fall to 2-month lows. It increases the fiscal risks in the UK and certainly undermines that sort of negative credit outlook as well for the UK. It allows the Aussie sterling to have a reprieve. We've seen Aussie sterling climb back up towards that 68 level, an opportune time for importers with sterling payables to take advantage of this now short term. We've seen the euro dollar retreat from its 7-month highs after the ECB lowered its inflation forecasts for the next 2 years. They also said that substantial stimulus was still needed. They've ruled out interest rate rises in Europe before the end of December, when the QE program ends. So even though they made some hawkish comments, we expect the ECB will taper their quantitative easing program, which means their monthly asset purchases will fall by about 10 billion euros a month until June next year, when the ECB will then look at raising interest rates away from that negative threshold that we see at the moment. So we expect the euro to be well supported on the downside. It's a buy on the dip strategy. Look for 111 to hold and back up towards 113, especially on the back of the Eurozone economy improving, on the back of some robust economic figures and this impending tightening cycle with interest rates. Also, the euro benefits from a very strong current account surplus. It's about 3.2% of GDP, and also increasing portfolio inflows into the Eurozone will help put a base underneath the euro. In the US, this economic growth continues to underwhelm. At the moment, it's about the US political uncertainty, but we've seen a flight to safety caused by the weaker than expected US employment numbers last week. Now, if the Federal Reserve in the US is truly data dependent, they won't raise interest rates this week, but the market expects they will. It's almost 90% priced in, which means we might see a dovish rate hike in the US. That is, we'll get a 0.25% rate rise announced early Thursday morning our time, and then they'll be on hold. They'll be on pause for the rest of this year, which will limit the upside for the US dollar. Now, in Japan, first quarter GDP growth slumped to 1% when the forecast was for it to grow above 2%. We also expect, inflation is non-existent in Japan, so even though the BOJ meets on Friday, we expect they'll continue to buy bonds and continue to expand their balance sheets. The main focus in Australia this week will be Thursday's employment data for May. We're expecting a positive 10,000 growth in jobs for the month of May. This follows April's 37,000 increase. Look for the unemployment rate to remain stable around 5.7%. This should support the Aussie dollar because the US dollar remains weak, and the Aussie dollar has had now some support because of the structural improvement in the current account deficit. Australia's current account deficit has now narrowed to only 0.7% of GDP. So that's a favour, if you like, for the Aussie dollar. Look for the Aussie US to perhaps re-challenge that 76.5 cent range later this week, especially if the employment data is better than expected. We know the RBA remains on hold for the rest of this year and maintains its neutral policy stance, which means the next rate hike or rate cut movements are roughly priced about the same. Thank you for watching Compass Global Markets, a weekly update. I'm Tony Boyadjian. Have a great week.